On the other hand, FundStrat's Tom Lee says investors are too cautious, and that has him keeping his bullish suit on. Let's bring him in, CNBC contributor Tom Lee, for more. You heard what Jim Cramer just said. He sees signs of froth that won't last. What do you say?
Well, I agree with him. I think there is signs of froth in the market in 2021. And some of the areas Michael Santoli mentioned, but these are, there were signs of froth every year since 2009. So I think one of the things we have to be mindful of is how pervasive that level of speculation is. It doesn't seem that high in our Zooms.
So it doesn't seem worse to you now than it did years ago?
I don't think this is. I think this is at a far lower level than even the biotech craze that was in that 2016 period.
What makes you say that?
Well, for instance, look at retail investor cash. They pulled out about $110 billion out of stocks at the start of this year. Mutual fund and equity ETF flows have been negative. It's been averaging $7 billion a week, which means people are not buying stocks or taking money out of stocks. And then if you look at measures of our institutional client sort of sentiment, it's not that bullish. And then we know hedge funds degrossed dramatically. In fact, it was almost a massacre in terms of hedge fund performance. They haven't put that capital back into the market. So I think more money has been leaking out of the stock market than coming in. And that doesn't, to me, seem like a formula for a frothy top. It's more of a, as Michael said, it's an air pocket that's being created here, which might be quite healthy.
But is it true or is it not true? Correct me if I've got the facts wrong, but specifically with respect to the retail investors, the trend of money moving out of stocks and into fixed income has been the case for quite a few years, with some periodic exceptions, right? They've missed out on
Tyler,
a lot of it.
Yeah, I mean, there's, the retail investor is multiple cohorts, because I think older Americans, like baby boomers plus, have been allocating to bonds. But this sort of shift into bonds is a 10-year story. I mean, in the last 10 years, $3 trillion of household savings flow has been created. 94% went to bonds. You look at any other 10-year period, unprecedented. Most of the time, it should be 50% or more into equities. So stocks have had no real net inflows. And now we start to see retail investors getting interested in equities in 2020. And just because they're starting to buy stocks, I don't know why we should say this is the top. I mean, this could be the first year out of 10 years where there's real inflows.
So if I sum it up in a quick, overly glib phrase, froth, yes, you see it. Danger zone, no, you don't.
Yes. I mean, if there was 30% of the stock market in insane territory and they were going up, gapping up 10% a day, then that's pretty scary. But, the aggregate market cap of everything that looks frothy is a tiny, tiny percentage of the stock market.
Shepard Smith here. Thanks for watching CNBC on YouTube.